Hello and welcome to today's corporate webinar with Smartkarma. I'm your host, Maliha Hadi. Today, I have the pleasure of welcoming Sasseur REIT's team to Smartkarma. In case you were unaware, Sasseur REIT is the first retail outlet mall REIT listed in Asia with assets strategically located in fast-growing cities in China. Today, we are joined by their CFO, Mr. Jianfeng, their COO, Mr. Chongqing Yuen, and Head of Investor Relations and Capital Markets, Ms. Helen. We're also joined by Smartkarma Insight Provider and real estate expert, Mr. Garreth Elston. Great to have you all with us. We will start the webinar with the Sasseur REIT team walking us through a company presentation, after which they will engage in an exciting fireside chat with Garreth. During the webinar, we'll also be taking live Q&A, so I would request our attendees to post any questions they have for the team at the bottom, in the Q&A tab at the bottom of your screens. During the webinar, we'll also share some links on how you can connect with Sasseur REIT and read more research by Garreth, so please do keep a lookout for any messages in the chat box. So let's dive right in with introduction to Sasseur REIT. Helen, the floor is yours.
All right, thank you, Hardy. Thank you for the kind introduction. So it's an honor to be part of today's Smartkarma webinar and to present Sasseur REIT. I will begin with a brief overview of the sponsor and the REIT, followed by Jianfeng, who will take you through the financials, and then Yuen will close with insights on performance of our underlying assets. So Phoebe, please go straight to slide 5. All right, Sasseur Group is the sponsor of Sasseur REIT, which was founded by Mr. Xu Rongcan and is a leading outlet operator in China. Over the past 17 years, the group has grown to operate 18 outlets across 16 cities. Out of these 18 outlets, 6 are owned by Sasseur Group, 4 of which have been injected into the REIT, and 12 are owned by third parties. Mr. Xu, our chairman, is deeply passionate about art, and in 2016, he pioneered the super outlet model, seamlessly combining art and commerce. Importantly, the group is not a traditional property developer and has maintained a very healthy and robust cash flow profile. Moving on, please. So this is the super outlet business model. Sasseur's unique super outlet business model is encapsulated by the formula of A times 1 plus N times DT times S, where A represents art. It's the artistic and immersive outlet designs that connect with both consumers and the local culture. 1 plus N is the experiential shopping centered on one of the outlets, which is the 1 factor, enhanced by multiple attractions, which is the N factor here. For example, we have a zoo at Hefei outlet and a strawberry farm at Bishan outlet, enriching the family-oriented retail experience and increasing customer dwell time. The third element, DT, is the data technology. So we leverage data to monitor tenant sales performance and consumer behavior. The last one, S, sustainability, is new this year. So true to our chairman's philosophy, we emphasize low gearing, ethical growth, and long-term sustainability. Next slide, please. So this slide illustrates the relationship between Sasseur Group, the sponsor, and Sasseur REIT. The sponsor operates under an asset-light model, while the REIT serves as the asset-heavy platform to support growth. So we currently own 4 outlets under the REIT, and we hold the ROFA on the Xi'an and Guiyang outlets for future acquisition opportunities. So now I'll move on to talk a little bit about the Sasseur REIT, the platform. So Sasseur REIT was listed on SGX in 2018. We are a small to mid-cap REIT offering a distribution yield of approximately over 9% nowadays. So now in our 7th year of listing, we remain focused on growing our AUM, market cap, as well as the liquidity. The 4 outlets currently under REIT are located in Chongqing. There are 2 assets there, Hefei and Kunming. Moving on to next slide, please. So from a capital markets perspective, Sasseur REIT offers a very compelling value proposition. Since IPO till the end of the first quarter, we've delivered nearly 50% of total return, significantly outperforming the S-REIT industry average of 18%. We maintain the lowest gearing among all S-REITs and consistently offer a higher than average yield. Dividend distributions have been remarkably stable even during the challenges of the COVID period. Later, Jianfeng will delve deeper into the core business model and explain the financial resilience behind this performance. So with that, I'll now hand over to Jianfeng to walk us through the financials. Jianfeng, over to you.
Okay, thanks, Helen, and good day, everyone. So now let's look at financials and the capital management side. First of all, so let me have a quick introduction of our EMA model. So if you look at the whole chart, on the left-hand side, it shows the underlying business model. So our outlet malls, we generate proceeds from sales of clothes, shoes, etc. from our end customers, and we collect the cash on behalf of our tenants. So Sasseur will take about 10 to 16% commission as our turnover rent. Then remit the remaining to our tenants 2 months later. So basically, what we fundamentally earned is the percentage of sales. And we call this as the green bar is the gross revenue. And on the right-hand side, you will note that we have adjusted this model a bit when we listed in Singapore in 2018. So the rental income has been split into 2 parts. One is called the fixed component, fixed EMA resultant rent. And this is fixed for 10 years after IPO and set a 3% annual escalation. And this fixed component is guaranteed underwritten by the entrusted manager, who is also our sponsor. And apart from that, the variable component is still packed to the sales, but the percentage is ranging lower than 10 to 6%. It's about 4 to 5.5% different with each outlet mall. So if you have noticed, the green bar of our gross revenue is normally higher than our pink bar of the EMA rental income. And the difference will be used as the entrusted manager base fee and paid to our interest manager. And this is up to a limit of 30% of our gross revenue. But if there's still any surplus, then it will be split between REIT and the entrusted manager by 60% and 40%. So that's how this module works. And the EMA rental income in this the pink bar is the Sasseur REIT's top line of financial statement. So moving on. And also this page shows our sales and the EMA rent after IPO. The bar here shows the sales figure in renminbi, and the line here shows the EMA numbers for each year after IPO. You can see that our sales reached a peak in year 2019 of renminbi 4.8 billion, but affected subsequently by COVID from year 2020 to 2022. During that time, below renminbi 4 billion level. However, we've seen a strong post-pandemic recovery in 2023 and 2024, with the sales again touching above 4 billion, reflecting the growing consumer demand and market confidence. So you know, the outlet industry in China actually is a beneficiary of consumption downgrade trend in China. As nowadays, many high-end or middle-class consumers have changed their consuming behavior. They used to go abroad for shopping, but now coming back domestically, especially preferring to visit outlet malls. So we can see this trend obviously via the macro data and our own statistics. And the EMA rent-wise, because of the EMA model, especially supported by the fixed rent, did not fluctuate as much as sales. It remained stable and resilient and even reached an all-time high in year 2024 with renminbi 664 million, even outperformed 2019, which is again showing the resilience of this business model. Okay, so next page. So this page can show the 2025 first quarter sales against EMA year-on-year comparison, which clearly demonstrated a relationship between sales and EMA rent. So in the past quarter, the sales decreased by 0.9%, which affected the variable portion of our EMA rent by 1.2%. However, with support from the fixed component of EMA rent, which increased 3% year-on-year, showing here, the total EMA in renminbi increased by 1.6% and reached renminbi 175 million. So because of the fixed component in this quarter takes up 67% of the total EMA, so the higher percentage of fixed part is the driving forces for our EMA improvement in the past years. So next page. Okay, so in this slide, we come to the capital management part, and the chart demonstrated the healthy debt maturity file. In the table below, you can see that we do not have immediate refinancing needs for year 2025. And also the refinancing needs for year 2026 was 42 million Singapore dollars, which is only 10% of our total loan profile. And the amount is not significant, and refinancing risk is manageable. Apart from that, the rest of our loans are from China banks and from our sponsor loan, from our sponsor, which matures from the year 2028 to 2035. And the focus in this year is we are trying different means to increase our renminbi portion while reducing the Singapore dollar or USD dollar portion borrowings. As currently, for most Chinese companies, the renminbi borrowings is much cheaper than offshore debt, so that replacement can reduce our interest cost accordingly. So on the right-hand side, you can see our efforts and results so far. So we have successfully secured 2 tranches of offshore renminbi sponsor loans amounting to renminbi 430 million and 508 million respectively this year. And the sponsor loan have more favorable terms than the existing offshore debt, and we fully utilize this to prepay the offshore debt maturing in 2026. Another milestone is a 10-year renminbi 308 million green loan from OCBC China at a competitive rate for onshore refinancing. And this is our first green sim loans and kick off a good start for the green initiative for us. And with all this done, as of now, 90% of our total loans are denominated in renminbi and now pegged to China 5-year LPR. And we can see a trend of cost downward in Sasseur REIT in line with China's easing up policy of interest rate to boost domestic economy. So just for your information, China 5-year LPR has dropped from 4.2% per annum 1 year ago till now 3.57%. So we will see a further drop in the near future. And this, with more renminbi debt, it will increase our natural hedging of currency exposure and improve our maturity years to 4.2 years. Okay, so next page. And again, this page shows our prudent approach on capital management side. And on the right-hand side, the loan profile I just talked about. But I need to mention that our cost of debt is around 5% per annum as of 31st March 2025. But this is not the most recent numbers. We expect it to drop further to below 5% going forward. And on the right-hand side, you can see our gearing ratio. It's 26%, which as Helen just said, is lowest among all the S-REIT. So based on this gearing and MAS, there's a limit of 50% upper limit. So with a sizable debt headroom of 895 million Singapore dollar, which could be leveraged for our future growth, say an acquisition. So next page. And okay, this page shows our portfolio valuation. So as of 31st December 2024, the portfolio valuation stood at renminbi 8.42 billion, a slight decrease of renminbi 77 million, 1% from the previous year. So in terms of each portfolio, our Chongqing Liangjiang increased by 59 million, and the other 3 dropped a bit. The valuation remains robust, supported by the strong operational fundamentals. And with this, I've ended my session, and now hand over to my colleague Yuen to continue the next part.
Thank you, Jianfeng and Helen. Welcome everybody for taking time off this afternoon to listen to our presentation. For my part, I will give you some snapshot and overview on our resilient portfolio performance. Next slide. Okay, this slide actually shows our trade mix. So on the left-hand side is the trade mix by NLA, and on the right-hand side is the trade mix by gross revenue. So our trade mix has remained relatively consistent quarter to quarter, with a significant trade mix that includes fashion, international brands, and sports. This trade mix account for approximately 62% of NLA and 82% by gross revenue. So you will see that risk is also mitigated with our top 10 tenants contributing less than 16% of gross revenue, and not a single tenant contributed more than 5% of our total gross revenue. Next slide. Okay, this slide is a highlight of our portfolio performance. You will see that our portfolio occupancy remains stable and at an occupancy rate of close to 99%, a record high since IPO. We have once again managed to achieve success above the pre-COVID occupancy of 96%. This is a result of our proactive leasing strategy and the result of our asset enhancement initiative, both of which contributed to this positive outcome. I would like to mention two outlets, one is Bishan and the other one Kunming, achieved record occupancy at 97% and 99.8%. Again, this is our effective leasing strategies for our outlets, involving a combination of careful planning, tenant selection, and ongoing proactive management. We also carefully select and place tenants to create a balanced and complementary mix. This helps us improve the overall performance of our property. Next slide. Okay, this slide shows our weighted average lease expiry. Our WALE versus last Q has remained stable at 2 years measured in terms of NLA and close to 1 year measured in terms of gross revenue. This is also a result of our high renewal rate as well as new leases signed throughout the year. So on the left-hand bar, you will see that there's this dotted line of 52.8% by NLA and 70.3% by gross revenue. So this basically shows in the last Q, those leases that is pending for expiry is higher, but within 3 months, we have brought it down to 47% by NLA and 52% by gross revenue. Then for those who are joining us for the first time, let me explain to you why our WALE are shorter. For example, you will see ours is about 2 years by NLA, around 1 year by gross revenue. This is actually shorter than the other REITs that you see, which you see around average around 3 years. The reason is due to our business model. We take a cut from the total sales for our rental. So we will monitor the performance of our tenant very closely. Those that are not performing will be replaced during our twice a year major tenant reconfiguration. So longer leases is actually detrimental to our performance. That means non-performing tenants cannot be terminated early to bring in new to market brand. Why we need that? Because the consumer market is always changing and shifting. Therefore, a flexible leasing approach is adopted to secure our optimal tenants mix. Next slide. Okay, this one shows some of our strategic asset enhancement initiative. Our outlet is doing well, but in order to stay competitive, we need to carry out AEI, Asset Enhancement Initiative, a strategic upgrade to improve value and customer experience. As you all know, in retail, consumer tastes are always changing. So the Chinese shoppers now demand immersive experience, not just shopping. So AEI allow us to add entertainment zone, F&B hubs to attract higher foot traffic. For example, on the left-hand side, you see a picture of KFC. This has been intentionally placed at the low traffic area in our Kunming outlet. So KFC has a natural draw for crowds. So by drawing crowds to this area, it also boosted the sales of tenants located in this quiet zone. Therefore, a well-executed AEI boosts our rental income, our occupancy rate, as well as our asset value, which you have seen it in Jianfeng's slide earlier on. Next slide. Okay, this is an ongoing capex at Chongqing Liangjiang. So the aircon system, which is more than 15 years, is due for renewal. So due for changing. So to boost efficiency and customer experience. Chongqing during summer is very hot, more than 40 degrees. So we require a more powerful energy efficient system to keep shoppers comfortable. So this is also part of our customer service provided to our shoppers, providing them a good environment for shopping. And this will also meet the China Greens Building Standard. Next slide. Okay, this one is our year-round promotional activities. We run a dynamic year-round promotional activity, blending seasonal sales, example, Chinese New Year, 618, 1111, then providing exclusive member discount and team events to drive footfall. Then we also have limited time flash sales, live streaming via WeChat and partnership with luxury brands, like for example, Mid-Autumn giveaway or anniversary sales. And with this, we also provide digital coupons and tiered loyalty rewards to incentivize repeat visit. The strategy balances urgency, time-sensitive offers, and exponential buzz. Next slide. Okay, this slide is our VIP member, another highlight of our operation. The number of VIP members has reached close to more than 4.3 million by end of 4Q 2024. The 4-year CAGR is close to 20%. Both Liangjiang and Hefei have around 65% of the total number of VIP members, and both of them have crossed the 1 million mark. So why we place a high value on the patronage of our VIP members? Because they contribute more than 60% to our total sales. Next slide. Okay, looking forward. So this is Chinese economy. So we like to bring to your attention that China has confidently reaffirmed its ambitious 5% GDP growth target for 2025, which showcased the economy remarkable resilience and robust fundamental despite the volatility and the headwinds that you all read in the news recently. So this bold projection underscores Beijing economic management fueled by strong domestic consumption, cutting-edge innovation, and industrial upgrading. So, and then we will also monitor the CCI. So in terms of CCI, it measures the consumer confidence, and you will see that it is aging up on a month-by-month basis to close to 88 by April 2025. So, and then on the right-hand side, this is China focused on intensifying its effort to stimulate domestic demand. All this spell well for us as a leading outlet operator, the Chinese mega domestic market. Next slide. Okay, in this slide is basically showing what our key management focus. So in terms of proactive asset management, we will continue to attract more retail experience, new and upcoming retail experience for our shoppers. And of course, we also strengthen our brand partnership and nurture VIP base. Then capital management, you will see that we are very healthy, very low gearing, very healthy interest rate ratio, and then we will continue to diversify our funding sources for reducing finance costs. Then in terms of acquisition-led growth, we will try to seek accretive acquisition to improve all unit holders' return. And we will target cities in China with large residential catchment and attractive growth potential. So with this, I end my presentation. I hand over the slide back to Helen.
All right, thanks, Yuen. Thanks, team, and thanks for listening to this presentation, everyone. So I guess here comes with the fireside chat, right?
Yes, that's correct, Helen. Thank you very much for the very comprehensive intro to the company. So we'll dive in further into this by transitioning to the next part of our webinar, which is the fireside chat. Garreth, over to you.
Thank you very much, and certainly a timely and very interesting presentation. I think we've started to see the situation in especially retail REITs listed in Singapore starting to become a lot more positive as economies and rates start to come down. And I think it's probably a very good time to start looking at the sector from an investor point of view, and I think this is definitely one of the companies that's definitely worth having more of a look in. If we can start off, I'm going to send the first question to Mr. Cheng, and really I think you've covered a lot of these details, but I think we'd like to drill down a little bit deeper. And I think what we're seeing outlet shopping in China is quite resilient. But we always notice, in any form of retail property, the patterns always shift very quickly. And are you seeing any challenging structural risks within the portfolio? And of these, how are you positioning the portfolio to deal with these and stay ahead of the curve?
Okay, thank you, Garrett. I will attempt to give you a comprehensive answer to this question. In your question, you say that there is a shifting fast. The consumer patterns are shifting fast. I agree, our consumer patterns are shifting fast, but I would like to reiterate, our Sasseur outlet is also adapting even faster. So in that sense, I would say that I will merge your two questions, meaning that the shifting patterns of the consumer and the structural risk, because these two, I would think they are intertwined and related. So there's first shift. What is the first shift? I think most of you would have heard of consumer downgrading in China over the past 1 year due to tightening of pocket, due to volatile economy and all other kinds of reasons. But our experience working with our outlet managers in China is that, yes, consumer is downgrading, but they are not cutting back on their spending. Instead, they are looking for more price, meaning that high quality at a more reasonable price. They are cautious, but they are looking for, they are continue to spend on good quality, fair price product. So for example, may I quote you, under the Asia Shopping's Priority 2025 by WGSN, the survey done that more than half, 56% of Chinese luxury consumer plan to increase their spending on domestic brands that are more relevant to their taste. So in an earlier slide that we have at the trade mix, I would say that we see this trend coming more than 2 years ago. So what we have actually done is that we have shifted more of our international brands to domestic brand. I think you would have heard some very popular sports domestic brands like Li-Ning, Angta, and all these are actually having factory outlets here, 2 levels, and expanding their space at our outlet. This is one of the first shift. What is the second shift? Which is something that many people did not take note. That is the youth consumers, those that are born after 1990s, the percentage of their consumer that are spending at our outlet, we are seeing a growing trend. These youthful consumers' shopping habits reflect this characteristic. They want high quality, but they want cheaper price. And they also want the product to be culturally distinct, and they desire for premium, personalization, and seamless digitalization. Okay, that would be the second shift. What will be my third shift? Just a minute. The third shift, of course, would be digitalization. What is digitalization? Meaning that consumer want convenience-driven leisure. Spaces has to be re-imaged to combine shopping, relaxation, social engagement, catering to modern consumer expectation. Okay, now how are we as Sasseur outlet repositioning our asset to stay ahead of that curve? So just now I said 3 shifts. So our operation actually now has one laser focus. What is the laser focus? Customer centric. Whatever that we do, whether we are bringing in new tenants, whether we are reconfiguring our space or doing AEI, the first thing that we must have is our consideration and understand what our customer wants. So some of the key things that we are doing at the outlet will be continuous brands refresh. That means we will bring in brands that are more in trend to cater more to evolving customer taste and market. You could refer to our past few quarters of slide where there are some details of it. Then the other one is that we will continue to enhance our VIP program. First and foremost, VIP program offers tier rewards, access to special events, and tailored services. For example, Coach is a very well-known brand in China, held exclusive member event to showcase the art of dressing as well as introducing their latest product. So I'm just quoting you an example so that these are things that we will attract and retain our customer. Then of course, we will also have proactive AEI, which I have already mentioned earlier. And then the most important thing is that we must have the price attractiveness. We make sure that we have the lowest price, best quality in town. And these are some of the things that we are actually focusing and enhancing at our outlet. So in short, these are some of the repositioning that we are doing at site. Then of course, on top of that, we will be doing AEI work, which I'll mention in a later question. Okay, thank you, Garrett.
Excellent, thanks. While I've got you, I'm going to drill a little deeper because the company is very interesting. And as you mentioned, you've got quite short WALEs, but extremely good occupancy, which often seems very different to most people looking at retail REITs. Is they always get excited about long WALEs and high occupancy, but you seem to have turned that on its head. Can you talk potentially about the type of tools and whether it's technology or what you're using to understand when you should be moving tenants out, when you start to see them struggling, and how you change and make sure that that tenancy mix is optimal to keep those occupancies high and the turnover high as well?
Okay, so to answer this question, right? Actually, our WALE is short, which I mentioned, because more than 90%, to be exact, around close to 95% of our tenants are actually signed based on a turnover rent. So just for clarity of our audience, what is turnover rent? Turnover rent means that the rental that we collect from the tenants is a percentage of the total sales. So for example, if they make $1,000 a month for this particular month, and we have a commission rate of 10%, meaning we will collect $100 of rental from them. So this model is actually not unique, but it is pressurizing for the operation manager. Why? Because if the sales of the tenants are not doing well, our rental will also be lower. So in that sense, what we are actually doing at site is this. We have a sales target for all our tenants on this rental model. So every month, I will set a target for you, and we will monitor, the operation manager will monitor them by weeks, by months, and by quarter. And if they do not hit the target, our short WALE will allow us to replace them. And of course, at our HQ site, they have a panel of, that means they have a pipeline of brands that span about close to 4,000 names in China. So these are in regular contact with them. So anytime that there is a space available in, say, Chongqing, Liangjiang, they will be introduced, curated to replace the weaker performance tenant. So this is how we track, monitor, and why the short WALE is actually beneficial for us.
Excellent. That's very, very interesting.
Yeah.
My next question is going to be to Jianfeng, and I think it's to dig a little bit deeper into the EMA structure. And I think a lot of people looking at it, I think you've explained it well and we understand a little bit more, but I think a lot of potential investors and analysts might often struggle with it being potentially both a strength and a risk. I wonder if you could comment on how you're seeing it being sustainable and carrying on under the current economic situation and looking forward. And what worries you the most, and what scenarios would concern you going forward when looking at EMA?
Okay, let me answer this. So you see that EMA is a very important part of our business model, right? So the beauty of the EMA is the protection to the unit holders with the fixed component. So the downward performance is quite predictable. If you first flip through our past performance, you will notice that the fixed component normally takes about 60% to 70% of our total EMA rent, and with a 3% escalation each year. So the downside risk is quite minimal. At least you have this rental income, right? So even in year 2020 and 2022, when the COVID was rampant in China, the impact to the EMA rent is quite small. And as I just mentioned, in 2024, the EMA rent even reached its all-time high. So this is a protection for the unit holders. But having said that, I also need to mention our variable portion, which is still pegged to sales. So providing the unit holders with the upside participation of our performance. So if sales improve, then the unit holder can also enjoy the growth of our performance. So with all these benefits, I've talked with our analysts and also many investors, and they have a very good opinion on this model. But however, there's still some concerns, okay, regarding this model. So one is the financial strength of the sponsor, because I just mentioned the fixed component is underwritten, is supported by the sponsor, which means they have a sort of like guarantee that, right? So this is very important because the sponsor actually is a private company in China. It's not a listed company, but because the sponsor nowadays is the largest outlet operator in China, and it adopts the asset-light business model, which means It's mainly the management role. It doesn't take care of the construction, the borrowing stuff. So the business asset light model can help our sponsor generate very good cash flow and help him to have access cash sitting on its balance sheet. And also its leverage is very small. Our boss, he's a very prudent person. You see, our gearing is 25%, but in our sponsor's gearing is even lower than that. It's below 15%. So we are very prudent approach. So in that case, we don't see any problem that the sponsor can will give up this underwritten thing. Okay. So the other concern that people will ask is how long the EMA model will last, how long the arrangement will be. So basically, in the current arrangement, the EMA model will last for 10 years, expire in 2028. So the people will ask, then we are going to afterwards. So, in the prospectus, it just said clearly that there's an option for us to extend the EMA agreement for an additional 10 years following 2028. But because it's the option and we still have 3 years to go. So now we are conducting the internal analysis and review of this just to see what's going to do in the next couple of years. So we will update the market if there's any significant developments on this. Yeah, so that's all this about the EMA rent. Yeah.
No, that's excellent. Thank you, Jianfeng. And I think it leads into what I'd like to discuss a little bit more is obviously listed property investors are always very interested in the yield and the strength of the yield. And you have quite a good payout ratio. Your yield is one of the best in the sector as well. And I wonder if you could just discuss how you balance keeping that high payout ratio and also dealing with your capital requirements. Okay. And your debt's pretty low, but it's around how do you also put that back into the portfolio, which I see, you have a lot of work on keeping the portfolio up and fresh and exciting for customers, which is very interesting to me.
It's about our distribution strategy, right? The capital use. Yeah. So over the past 5 years, our payout ratio has been consistently ranging between 91% to 93%, reflecting cash retention of approximately 7 to 9%, which is actually very, very high. But you know why? Because this aligns with the standard market practice in Singapore. The REITs are required to distribute at least 90% of our taxable income to maintain the tax transparency status. So everybody can get tax-free when you get dividend because of these regulations. So our distribution policy and carefully balance the goal of the deliver stable returns. Also, we need to return some for our prudent capital management. And we retain cash mainly for two purposes. One is to repay our onshore, our China borrowings, the amortization, as this is required by the China regulatory, that you need to prepay your principals for a couple of years. You cannot repay in one go in a prepayment after maturity. You need to repay the principals each year. So we need to retain cash for this prepayment. And the other, Yuen just talked about, we need to do some AEI. So this AEI are aimed at preserving and growing the long-term value of our portfolios. So that's what we do now. Yeah.
Great, thank you very much. But my next question will be to Helen, and I think looking at Sasseur, it's a company that is performing well, distributions are good, yield is attractive, probably quite undervalued by the market. And Helen, what are your thoughts around why? What are people getting wrong about Sasseur? What are people not noticing? What do you think is the way for them to come in and understand a bit more about the positives that the company can offer?
Okay, thank you, Garreth, for the critical question. Okay, so first of all, I guess we need to participate in more of the events like this, right? So to get people know about us, the true color of us. But I guess back to your question, right? I wouldn't say the market misunderstands us, but I guess there are definite areas where Sasseur REIT's value isn't fully appreciated. So a key example is our China exposure. So there are a lot of concerns about the macro environment, like slower growth and geopolitical risks get a lot of attention. They often, I guess, overshadow the strength of our business model, which has been explained by Yuen, right? So our outlet malls serve China's growing value-conscious middle class, and it's growing. That segment has remained very resilient. Unlike traditional retail, our commission-based model aligns our interests with tenants, which supports, I guess, the stable performance even in uncertain times. And this is reflected in our consistent dividend track record, you could see. I guess another differentiator is our EMA model, which has been explained by Jianfeng, right? It cushions the downside with a fixed income component while still allowing upside when sales are strong. So that balance of stability and growth is a core part of our appeal. I guess ultimately what we offer to our investors, I think from my perspective, is an attractive risk-adjusted return. So since IPO through Q1 2025, as I talked through the presentation, our total return is close to 50%, very attractive, far above the market average of around 18%. And with one of the lowest gearing levels in the industry, about 25%, we are in a strong position to deliver high quality distributions and support future growth. So I guess this is the value proposition we could offer to the capital market, and we welcome like more questions and attentions to us so that we can explain more to them, like who we are and what we are doing.
Excellent, thanks. And just before I dig a bit deeper into that, just to remind the audience, please, if you have questions and you'd like to start sending them through, please use the Q&A facility and start typing those through. We're going to get onto those soon. Helen, also, I think it's also been discussed a little bit about the edge and the plus that the sponsor gives. And I don't know if you'd like to dig a little bit deeper into that and give any examples of really the backing that you get from the overall group that adds more value to Sasseur REIT.
Yeah, definitely. This presentation starts with the sponsor, right? Because we believe a strong sponsor is very important to us. So because as mentioned during the presentation about the structure, right? Sasseur Group actually adopts a two-pronged strategy. So positioning the REIT as the asset-heavy platform, which enables effective capital recycling for the sponsor. But in turn, the sponsor contributes deep expertise in outlet operations and financial support, as well as the strategic growth initiatives to the REIT. So this structure creates strong alignment between the sponsor and Sasseur REIT. So I guess operationally, the sponsor brings deep experience from managing 18 outlets malls across 16 cities in China. And in 2016, they introduced the super outlet model, which goes beyond traditional retail to incorporate lifestyle and experiential elements. This model has been a game changer, I would say, allowing our malls to stand out and perform strongly, even in a challenging retail environment. And on the financial side, I guess Jianfeng has touched a bit on that, about the debt profile. So the sponsor has provided RMB-denominated loans with attractive terms. This support has allowed us to optimize our capital structure, achieving a lower cost of debt, longer tenors, and a natural hedge against currency fluctuations. So these would be some examples of like how the sponsor's involvement directly enhances both operationally and financially to support the REIT to grow.
Helen, can I add on something to this question? Garrett, don't mind, just a quick one. So maybe I add on two more points. I will quote you some examples. For example, actually, the sponsor is actually our chairman, Xu, is very passionate about his outlet malls, and he's very detailed and he focuses on the operational details. This is something that he has set a benchmark for outlet management in China. So having Sasseur REITs in Singapore offers an opportunity for investor to invest in this excellent management and his passion for outlet. Then the other one is that in terms of financial support from the sponsor, I would like to bring you back to 2020. In February, there was a closure in China, across China. All our 4 outlets was closed for 7 weeks. And if you recall, more than 95% of our leases is based on cut on our total sales. So during that time, there was no sales. So what happened is that the tenants has actually asked for rental rebates, and our sponsor has generously shoulder the rental rebates at their own cost without burdening the Sasseur REITs or the REITs platform. So just some add on to this sponsors relationship to us. Okay. Thanks.
Excellent. No, thank you very much. And I think that then leads me on to my next discussion point, which is really around you're based, all the assets are based in China. And there's always, everyone was always trying to understand how the Chinese market and potential impacts around there. Are there any geopolitical issues that you're worried about at the moment? Any regulatory risk issues that you feel should be highlighted, or are you finding that things have mainly started to settle down now and everything is calm and you're not really finding this as a concern in your business? I think, people looking from the outside in, it's always difficult for us to get as much of a clear view as you do, being more on the ground.
Okay, let me start first on this question. So from the capital side perspective, China is very heavily on the cash restriction, especially for the cash outside of China, because the currency is divided between Chinese renminbi and the other currencies. So this is very heavily regulated things. But from the perspective of foreign capital and capital control, some may assume that as a China REIT, it will be difficult for us to repatriate the funds, especially our dividends abroad, right? But this is not necessary for the case for us. This is because our operations are run through the property companies classified as retail nature, not real estate nature. This is showing our business license. Because in China, if you are real estate nature, you have no possibility to repatriate your funds abroad. But because our nature is the retail, classified as retail, then repatriating cash and distributing dividends does not conflict with the existing capital control regulations, which makes the process relatively smooth. So currently, there are several ways to repatriate profits from China to Singapore. The most used one is the issuance, the dividend to the parent company. And also we just do the repayment of shareholders' loans and the repayment of the interest. So that's how it works. I don't know if Yuen has other things to address.
Yuen, you are on mute.
Just a quick one. Geopolitical, actually, we have to see two-dimensional. One is external, one is domestic. So external, I don't need to mention. You read it in the news every day. So, but actually, domestic-wise, in my earlier presentation, China is actually going 110% on triggering their domestic demand. Why are they doing this? Because they want to counter the effects of the external volatility. So that spells well for us because people are buying. And so the saving rates in China is very, very high. In the latest report I see, it has crossed RMB 1 trillion. So what the government is actually trying to do is to make people to spend on consumer goods. And once they are able to do that, that will spell well for Sasseur REIT. And that is why our sponsor continue to increase the number of outlets across China. Then on top of that, maybe I just highlight a bit on tariffs. This tariff war, when it first started in April, we have a lot of questions from our unit holders, but actually it has no impact on us. Why? Most of the products are actually manufactured in China. In fact, when now they cannot export, it will come to our outlet at a higher discount. So, Garreth, I hope we have addressed your question.
Excellent. Yes, it does. Thank you. And I think this will be my last question before we move on to audience questions. And I think it's looking forward, 3 years out for so what is success going to look like for the company? Beyond just continuing good distributions per unit, what are you looking at investors to judge you in if we look 3 years forward for the company, and what can investors potentially look forward to from the company? Thank you. And that's to any one of the team.
Okay, I will take on this question. So looking ahead of 3 years ahead, our success is not only on DPU. We want to build a stronger, more resilient platform across 3 key areas. The first one, of course, is asset performance, which we have mentioned a lot. Secondly, we have very low gearing. That means that allows for a lot of headroom for acquisition and for our strategic growth. So on the organic front, we aim to maintain a high-performing asset portfolio through proactive AEI and then deeper partnership with key retail brands. Then from the capital management perspective, we focus on optimizing our funding mix. Then for inorganic growth, which we have a lot of questions from our investors previously, we will see strong potential in acquiring quality outlet assets managed by our sponsor, 18 so far. So ultimately, we want our investors to judge us not by our distribution, but by how well we have balanced growth with financial prudence. Thank you.
Excellent. Great, thank you. I think we'll move on to the audience questions, and we've had quite a few that have flown in, which is always great to see. As with most presentations, there's always the question whenever there's a company that looks undervalued, and I think we'll start off with that, and that's from an anonymous question is asking, are you considering share buybacks at all in the REIT?
Okay, Tim, you can take that,
Yeah,
right?
let me-
Okay.
Well, I just answer this from a cash management perspective. The thing is that I just mentioned, the regulation in Singapore require 90% to be used as a dividend. Unfortunately, this 90% does not include the share buyback, which means we can only retain 10% of our cash for our operation. I just said to pay for the amortization of onshore debt, pay for our AEI. So the thing is that we don't have room. We don't have room to pay for the share buyback. Although we know it's very good method to increase our share price. But what we can do is to do other stuff, like we decrease our cost of capital, and we just do better our operation just to increase our DPU. Yeah. So Helen, your turn.
Okay. I just want to add on, right? Because nowadays sponsor has around 57% stake in us in the REIT platform, right? It's already a lot, so which is causing the free flow a little bit weak. So if assume that they are doing share buybacks, I guess that would affect the free float even more, which is harder for us to approach for, high quality investors and to boost the liquidity and help with the stock price. So that would be the interpretation from us.
Excellent, thank you. And then the next question we have is the company looking at any potential other listings of the company, whether that's in China or anywhere else potentially?
Yes, okay. Also, let me answer first. So, yes, we also noticed some of our peers, they are just trying to do the China REIT C-REIT IPO, use the S-REIT as the sponsor. And okay, let's set a good let's set up very good path for us. So we are looking at them, and we also agree that the China's valuation is rather good. So we're just watching at what they are doing, and we do not rule out the possibility that we go to China to get the C-REIT.
Okay, great. And then we have a couple of questions that we're asking around the same field, really, which is looking at the current portfolio size and assets under management. Are there any plans in order to add some new properties and outlets into the portfolio at all going forward?
I will take on this question. So this question is actually very important for us as well. Definitely, we are actually seriously looking at increasing the size of our AUM. So for us, actually, the sponsor actually has managing 18 outlets, out of which 4 is already injected into our Sasseur REIT platform, and 2 of which are ROFR, Xi'an and Guiyang. And the remaining are actually assets which are asset-like. That means it belongs to a developer or other owners, but our sponsor actually signed a 10 to 20 years management agreement with them. So this actually gives us a great opportunity to acquire the asset-like properties from the owners or the developer. First and foremost, there is a motivation for them to sell. Why? Because they are not expertise in outlet management. Secondly, this will also help them with their tight cash flow. As you are aware, property developers in China are facing some headwinds over the past 3 years. So we are actually now looking at the across China, that means north, south, east, west, and we hope we can give you some good news in the near future. So definitely, we are actually looking at all these properties.
Excellent. The next question is looking, it'll be for the CFO, is looking at the cost of financing and what your view is on the cost of financing in the second half of the year, whether you're seeing it going lower at all, or what your outlook is.
Yes, it will go lower because the currently the finance cost is 5%. It's as of 31st of March this year. So in the second quarter, as I just mentioned, we've done many efforts with securing more onshore debt. So because the onshore debt is cheaper than the offshore debt, so in the second quarter, it will drop. Again, I just also mentioned the China PR, the China interest rate is on a downward trend. So all this will contribute to the downward of our interest rate. So I would say that definitely in the next 2 quarters, the interest rate will going downwards below 5%.
Okay, excellent. That's good news. The next question is about, again, about Chinese domestic demand, where they mentioned that you're seeing it as being very positive. But if it starts to slow down and there's also potentially further RMB depreciation, what plans do you have in place to address this in your operations?
Okay, maybe I'll take on this question. Then, Jianfeng, you can assist me with the RMB depreciation on your hedging policy. So for the Chinese domain, in the event, of course, now we are seeing a positive growth, like CCI has hit about 88% consumer confidence index. But in the event of a consumer downgrade, that means a weak consumer demand. What are we doing on site to actually reverse this trend? So what we are actually doing now is that in the event of this happening, we are already working with all the major brands like Nike, Adidas, or maybe Li-Ning, and some of the domestic fashion brands. What have they installed in their inventory if suddenly the consumer consumption becomes weaker? So what we are going to do is that we are going to revamp our promotional program. We are going to introduce more wider range of goods that is in their inventory at an even higher discount. So as I mentioned before, just now we already said, yes, there's consumer downgrade, but the consumer are not actually downgrading on their spending. They are actually looking for more value-added products. This is something that we have seen in the Chinese consumer. So in the event of a weaker consumption, what we do is that we revise the product range, and of course, we will improve our promotional program online and offline. This is our plan. So for Jianfeng, would you just weigh on the
currency.
RMB depreciation?
Sure. So on the currency front, we are continue to monitor the renminbi Singapore dollar exchange rate movements. We are active managing our forex exposure through a combination of natural and structured hedging strategies. So in terms of the natural hedging, because as I just say, our renminbi borrowings now is about 90%. We increased it a lot this year. So this will better align our debt structure with our revenue base, reducing the earning volatility from currency mismatches. And in terms of the structure forex hedging, we actually have implemented a disciplined hedging policy, typically covering 30% to 100% of our foreign currency exposure using forward contracts. Because given the current volatile situations, we normally use the upper end, which is 100% of our currency exposure. We are doing the execute is 3 to 6 months ahead of our distribution payments. So it's to help to stabilize our payout ratio and mitigate forex risk. So what we do is we get quotations from many banks, and we choose always treat every day and choose the best timing, best window, and best quotation to do that. So we cannot change the trend, but what we can do is we just to mitigate the risk exposure. Yeah, that's it.
Excellent, thank you. And I think it's been a fascinating insight into the company, and I think the audience definitely should have got some great insights into something that's definitely worth having a further look at. There are one or two questions still that we haven't got time to get through, but we will answer those through Smartkarma, so please just keep an eye open for that. I'm now going to pass back over to Malia, and thank you very much. I think it's been fascinating.
Thank you, Garrett.
Okay.
Thank you, everyone. So for anyone else who still has questions, you can drop them off on our Smartkarma Insight, and we have Helen, who is also available on Smartkarma to answer any potential queries you have for Sasseur REIT. I'd just like to round off by thanking our panelists for today's session. We have certainly learned a lot about Sasseur REIT here, and it has been a very invigorating one. I'd also like to thank our attendees who joined the session live and who've asked some very relevant, interesting questions. As I mentioned above, if you have any queries, you can feel free to post them on the webinar's Insight, and we will get back to you. So with that, I'd like to wrap up today's webinar. Thank you very much and have a great week ahead. Thank you, everyone.
Thank you.
Thanks,
Okay,
everyone.
thank you.
Thank you.
Bye.